Lululemon stock is down almost 70% since all-time highs, since December of 2023. Today, we're going to be looking not just at the numbers, but we're also going to be making an investment thesis based on the numbers. Last video I made on Lululemon, I compared it to Nike stock, and we went through a lot of similar numbers that we're going to look at today. But in this video, I'm going to be focusing 100% on Lululemon, and yeah, we're just going to be talking about whether or not we should put a lot of money into it. I already have invested in Lululemon and a bunch of other footwear and apparel type of companies. So here in my eToro portfolio, where every trade that I make is public and you can access this and you can visualize. You can see all of the investments I made here. But yeah, where is Lululemon? It's sitting at around 2% invested right now. I did buy and I doubled up earlier in September, 5th of September, and then I added a bit more yesterday at 161. But it's gonna, my average open is 171, which is I'm very happy about this number. But I might add more. Depends. I'll see what I can trim and what I want to trim and what is available for me to trim. But yeah, I also have Crocs in here as a footwear an apparel company, and then we also have Deckers Outdoor. Deckers Outdoor already went up by almost 20%, so just gonna leave this there to continue to make gains for me. But yeah, Lululemon keeps going down and it becomes more and more and more attractive buy. So 70% down. We're just gonna make a list of things that we observe by just looking at the numbers. There are many ways to make money in the stock market. For me personally, it's not only easy, but it's basically the only way I want to invest, just based on the numbers, because I want to work based on reality. I like logic and I hate being delusional. I do not want to make any type of investments based on hopium and basically delusions like other people. I don't know, just to give an example, they think about Palantir and what's it's going to do in the future. I rarely try to predict the future by using, I don't know, looking at the stars, astrology, saying stuff like, oh, they're going to do this and this and that because it just sounds good. I try to predict the future by looking at the numbers. I try to be based in reality, even though I might not have huge amount of gains in some investments. I'm not trying to make more than 100% on my investments, but that's just the way I invest. And I try to make 30, 50, 80% consistently with pretty much all of my trades, and I'm trying to outperform the S&P 500 over time that way. And Lululemon stock is one of those situations where a very high quality company has gone down by a lot and presents itself as an opportunity for me to make some money. So let's see here. This graph looks very attractive to me. I mean, something going down by more than 60%. I mean, that's a lot, okay? That is a huge percentage. So let's just make a quick math here. Quick calculation, 160. Let's go back to where it was, 160. Before 2019. Somewhere in here, so 169. Yeah, that's good. 169, that's our average cost basis. In order for the price to go back up to where it was at all-time highs, if we hold this, we would make 200% on our money. So 200% is a very good deal if we predict that it's actually going to go back up to those price levels again. So let's just put this in as a green flag, okay? Let's just say green flags, and then we're gonna color code them, okay? Price is down almost 70% from all-time high. So we're getting a huge discount on a very high quality company, and we're gonna obviously take a look at the numbers. So it had a steep drop from December 2023 until August 2024. Then it bounced back violently by going up 70%. And then the downtrend continues. Okay, the downtrend started in December 2023. When is it going to stop? Well, we're going to try to predict that as well. Looking at the numbers, okay? Looking at what type of numbers? Well, looking at the market cap and looking, for example, at the cash amount that they have, you know? Let's say the company doesn't burn any cash. Let's say the company doesn't have any debt and it just brings in more and more cash every year. And let's say they have 4 billion in the bank right now. Would you buy this? I mean, you're just going to have to take a look. How much more cash do they bring each year? And you're going to say, yeah, I want to buy something that's worth $19 billion currently that has around 5 billion in cash and brings in around 1 billion each year, and more, it increases their cash pile by 1 billion each year after covering all the expensive and everything. So let's just take a look here. PE ratio 11. Forward PE is higher. What does this mean? This means that there is a deterioration of the fundamentals. The earnings are going to be lower in the future. That's why the PE is higher. So the stock price is going down by a lot, but obviously there is something going on with the company that they are guiding lower earnings. They are guiding like weaker type of revenue, slower growth, and lower earnings, stuff like that. So the market reacts very violently to these type of things. When the company is growing fast, the stock price tends to overshoot on the upside, and then when it crashes, it's when company slows down the growth and people are not so excited about that specific company anymore, it tends to completely crash and overshoot on the downside. So I'm not I do not follow trends, so I buy only when it's gone down. I only buy when it's low, so I would never have bought this when it's been going up and up and up, because I just don't know when it's going to stop. So is it going to stop here in 2021? Should I sell here after this steep drop? It went back up in the next year or so, in next 2 years. So when am I going to sell it? I don't know. But if I buy it when it's low, then I know that the past all-time high price was at 500, and the valuation there, I can take a look and see what it was when it was very overvalued, and see what the people were paying it for that at that time, what type of valuation the market was setting the stock price at. So obviously I'm not going to say that it's going to go back to those type of valuations, but I can make some type of calculations and say that my risk is going to be tremendously reduced when looking at the valuations when the stock price has been going down by more than 70%. If indeed the fundamentals have not deteriorated so heavily that it's uninvestable anymore. So obviously, right off the bat, looking at this type of revenue, the revenue is not going down. It's cooling off. That's all it is. From what I can see here, it's just cooling off, okay? 10 years ago, it was bringing in $2 billion. Today, it's bringing in, well, let's just say this is trailing 12 months. But if they come out in the next quarter for the whole 2025, actually, they reported 2025. Yeah, let's just say more than 10 billion, okay? So more than 5 times. This is like a high technology company growth, okay? Something that I invested recently, Synopsys, did not have this type of growth over the last 10 years. And we're talking about the semiconductor industry. I mean, this is a software provider for the chip designers to use and create their chips. I mean, look at this. 2.2 billion, 6.4 billion, less than 3 times. Lululemon, what's been going on here? Around 2 billion, and now they're bringing in more than $10 billion. This is ridiculous, okay? Ridiculously high growth. And let's take a look by quarterly to just to see the type of cyclicality. So they do have cyclicality, reporting a lot higher numbers in January, probably because the past 3 months were the best. So basically November, December, those kind of months, they're probably bringing in a lot more cash during the year. People making gifts, people buying new clothes, stuff like that. A little bit of an anomaly here in 2020 where they reported much less earnings. 650 million in May 3 of 2020 compared to May 5th of 2019. They were bringing 780 million. So not a huge drop, but yeah, it was 2020, the pandemic. Everything was in lockdown, including stores and stuff like that. To be expected, but they quickly recovered, and yeah, up we go from there. No problem. And it doesn't seem, I don't see this trend breaking. Let's see here, April 2024, 2.2 billion in a quarter. This May, 2.4 billion almost. So keeps on growing. Yeah, just I don't see anything wrong with the top line there. Yes, the revenue growth is cooling down, but after you have something like 42% gain in 1 year, followed and then by a 29% gain, you would say, man, this has to be going down at some point or cooling off, starting to. But no, it added 18% more in 2024. And keep in mind, 2022 wasn't such a hot year for the stock market. And then 2024, 18% added onto it again, 10% more, 9% more. And you're looking at this, and if you didn't know what was happening with the stock price, you would say, there's no way that this company isn't going up consistently over time. But the stock market doesn't work like that. The stock market usually inflates a stock very early on with sticks a very high valuation to it, and then it pops. It just goes like that. Bubbles are formed, and then they pop, and then you have very good opportunities to get into high quality stocks. If you're impatient and you're buying here and here when everything is going perfectly, yeah, you might even make, if you buy here and hold it for 10 years, yeah, you're going to be up, but you're not going to make as much money as I am when buying here, okay, at 159 on 160. You've been buying at 400, more than double that average cost basis as I do, and I'm already going to be out in 10 years from this company. I'm going to be looking for other opportunities. I'm not a long-term investor. I am fully invested in stocks in the long term, but I change around. I want to have very large margin of safety, so I'm always close to the bottom. If you take a look at my portfolio here, I'm mostly up in the green, but only Alibaba is up by a significant amount because I've been holding it since 2024. So let's take a look here. December 2024, and then my last purchase was in July this year when it went down to about 104. And the rest of them are just PepsiCo went down a lot. I bought it. Now it's up. Novo Nordisk, but it's still, if we take a look at the graphs, it barely moved from the bottom a little bit, okay? And it's still, I mean, this is a new trend. I'm just going to keep it, and it's going to go higher and higher from here, but obviously zigzagging along the way. Novo Nordisk, again, if you take a look, I mean, we're pretty much close to the bottom. So yeah, down 61% as well. UNH, this had a relief rally, but same story here. Something that went down by a lot. I bought it. Yes, visibly has detached from the it has detached from the lows, and you can visibly see it on the graph, even in the long-term graph. But yeah, a lot of the companies that you find in here are just close to the bottom, you know. So if the stock market, which is at all-time highs, if it starts dipping and going down by 15-20%, my portfolio is gonna vastly outperform, and it's not going to be going down. And I can show you in the next couple of videos. I will show you my performance compared to the S&P when the S&P is going down. My portfolio is not going to be going down by a lot. Why? Because I have all of these stocks that are basically close to the bottom anyway. So how much can they go down from there? Not a lot. So that's why I think buying at the bottom, buying very low, it's very important. It gives you a lot of margin of safety. Because you just have you go to the balance sheet and you look at cash and cash equivalents, and you see something like this, $2 billion, more than 10% in market cap, and you're gonna say, yeah, this cannot just go down by 70% more after it dropped 60 or 70%. So, but when you're invested in something like Palantir, this obviously can easily go down by 70% or more, which is why I have shorted Palantir here, made some nice gains. But anyway, that's for another video. Let's see here, what's going on. Let's see here. Let's take a look at shares changes year on year at the percentages. So a few things we want to take a look at here. Is the management pouring buybacks regardless of the price? Or is it a smart type of management where it slows down the buybacks when the share price are at all-time high? As you can see here, they haven't bought back almost any shares in 2021, 2022, and then also 2024, which is exactly the highest points in the price graph. In the price on the graph here. So 2024, they haven't bought a lot. The share prices, the price of the shares were at pretty much all-time high. Also 2021. So they weren't buying here and they were not buying here. And they bought a little bit here, and then they started buying back more heavily. So this is exactly, so look at this, 2022, not a lot of buybacks. And then when the price went down, 2023, they started buying back some more. And now they are heavily buying back stock. So this is a massive green flag. This is two aspects, smart management buybacks, and then accelerating. Actually, we need to take a look at the cash flows to see that if they are actually accelerating the buybacks, or it's just a bigger percentage just because the stock price is down by a lot. So let's take a look by quarterlies here to see. So since 2023, yeah, they started to pour more money into buybacks. And July 2024, 600 million compared to August 2025. They did a lot less this year. Yeah, which is not very exciting to see, but yeah, the dates, I don't know, they're not consistent. April, we need to compare May 4th, 2025 to April 2024. So they did more in April and they did less in this quarter compared to last year's quarter. So are they accelerating? Yeah, sure. If you take a look at the whole decade here, they are able to put a lot more money into buybacks. They have become more and more profitable, and they have a lot of cash on hand. Then it's a good time to buy back the stock when it's down so much. So they have been doing that, but I would like to see even higher acceleration, or at least maintaining this type of level. More than 1.5 billion compared to a market cap of 19 billion. I mean, that's amazing. I mean, that's 7% or so. That's amazing. If the stock price just remains the same and they just put the same amount of money into buybacks, the valuation is going to be cheaper and cheaper and cheaper to a point where it becomes so ridiculous that the price is going to violently move up. And yeah, let's take a look at the gross margins. The margins for this type of company, which is fashion and apparel, is kind of ridiculous. This is software-like business. This is technology-like margins, okay? This is the margins that Google has. 60% and trending up. So this is another green flag. Not a massive green flag, but it is a green flag. Huge and upward trend. Upward trend over the past 10 years. Huge margins for this type of company and upward trending. Both green flags, okay? Margins, I didn't say gross margins. All of the margins are in the same. I mean, they're all going to move in the same manner. So the management is a good management. They are able to make the company more and more efficient and increase operating margins over time, which is another green flag. But yeah, that's what we wrote here. Yeah, all of the margins are looking very good. This is something I would really like to own over the long term. So I'm just gonna make my portfolio I'm gonna fill my portfolio with these type of companies, and over time I'm just gonna outperform the S&P 500, which has hundreds of companies that do not have these type of margins. And this is not 23% is not a lot higher than the S&P average, but buying it at a 70% discount is great. I mean, imagine buying the S&P 500, which is like 15% operating margin, at a 70% price drop. Okay, gross margins of the S&P 500 is around 45%. The operating margins is around 15%. Okay, so imagine this graph being the S&P 500. Would you buy it? And you say, yeah, I would be buying it with both of my hands. So obviously, when trying to outperform the S&P, we are trying to go for the best bargains possible, highest margins of safety that we can get, and the highest chances that we outperform the S&P with each trade. So let's just take a look at the balance sheet. Cash and cash equivalents, net positive over the last 10 years. They always had excess cash on hand, 500 million 10 years ago, and the market cap was 8 billion back then. So they always kept a lot of money on their hand. Last year, $2 billion. So compared to today's market cap, I don't know why this site sometimes shows trailing 12 months as this current year, and then now it shows 2024 and 2025. So I'm a bit confused. Do they have 2 billion right now in 2025, or they have just reported in February this year? I have no idea. Yeah, for a lot of stocks, the trailing 12 months will end at the end of the year. So you would compare trailing 12 months to last year. So we take a look at this number, which is much lower for this trailing 12 months, but I don't think this is for the whole year. It's going to be like this for the whole year, but we're going to monitor on this site. I'm going to be monitoring these numbers on this site because I'm curious how they change. But anyway, let's just say 2025, they have around 10% of the market cap in cash. Okay. It's either 5% or 10%, I'm not sure. But let's go with 7%, which is a lot. Okay, this is a company that has capex and they have brick and mortar stores, so they have a lot of assets, they have a lot of liabilities as well. They don't need to keep a lot of cash, but they just have a lot of cash because they have very high margins and the company is very high quality and is just able to afford holding that cash. Shareholder equity trending up over time very nicely, and we're sitting about 4 billion in equity. compare that to the market cap of less than 20 billion, around 19. That is a positive, but I'm not gonna mark it as a green flag because I'm not really interested in shareholders' equity. It doesn't mean that much for me personally anyway. Total debt, it has gone up over time, but 5 years ago it was 700 million. Today is 1.7 billion. And net cash, we have gone into negative territory. So a little bit of deterioration here, not of the fundamentals, but just of the balance sheet overall. It was pristine balance sheet, but now it's just good. It's very good balance sheet. And we're just gonna take a note here. Very good. It's not fortress-like balance sheet. It's not pristine, but actually for the type of company, I mean, I actually forgot. I was thinking I'm analyzing some type of software company. I would say actually it's kind of pristine balance. Let's not lie to each other. I mean, compared to something like Nike stock, I mean, what are we talking about? Net cash down 4 billion. Yeah, it's all over the place. More negative than positive over the past 5 years. I would say compared to something like Deckers Outdoor, which is another very high quality company that I own, it's a bit less. Yeah, this is a pristine example. Deckers Outdoor and Lululemon is just very good balance sheet numbers. Let's move on to cash flow now. Net income, extremely high. Almost 10% in net income. That's a massive green flag. Almost 10% of market cap in annual net income. I mean, there's nothing else to say. Stock-based compensation. I love this. 63 million. I mean, buying a company that has a market cap of 19 billion, it brings in almost 10% in net income of the market cap, and stock-based compensation is almost non-existent. So I am very, very happy to see this. Again, let's compare to Synopsys, semiconductor software industry. And this company is right now sitting at around 80 billion. It's bringing in $2 billion in net income. So a very low percentage of the market cap in net income. And the stock-based compensation is 800 million. Okay, that is huge compared to the net income. Let's go back to Lululemon. They do not need any type of special talent. They just have regular employees and a management team that doesn't need to be very large. Okay, you don't need thousands of people working on projects and stuff like that. This is not a high-tech company. So stock-based compensation, almost non-existent. I do not even want to calculate the percentages, what it represents out of the net income or the top line revenue. 74 million compared to 11 billion or whatever it was. It's nothing. Okay, stock-based compensation, non-existent. Non-existent. I hope I wrote that word correctly, but anyway, this is a massive green flag, of course. Repurchases of common stock. I'm gonna say we did touch on this, but I would say, yeah, this is not a massive green flag, but we're gonna color code it, and I would show you what type of green flag I think it is. Issuance of common stock. They don't issue a lot of stock. They don't need to. They don't have excessive stock-based compensation. Everything looking great. So in the red flag department, I don't think we're gonna find the red flag to put in there. But market cap, let's take a look by quarter. So right now we're at 19 billion. We're gonna have to go back in time and see back when was this around 19 billion. So February of 2019, the beginning of 2019, 3 more months and we enter 2026. So that's 7 years ago. Okay, market cap, the same as 7 years ago. That's something very positive. We are buying a company that we forgot to put in the green flag about the revenue. Extremely high growth from revenue. Very high growth in the top line. And the market cap regressed by 7 years. But if we take a look at the revenue, 7 years ago, it was bringing in a top line of 3.3 billion, and now it's at 11 billion. So you take a look and say, yeah, this makes no sense at all. Why would this stock go down, and why would it today be valued at 19 billion when all of the metrics have improved over time and it has grown to be 3 times the company that it was a couple of years ago. That's very simple. Why? Because it was in a bubble. Okay, let's take a look at the PE ratio. PE ratio right now is at 11. Okay, 2019 it was 40 as it was growing, and it gone up to 70. I mean, that's a clear bubble, and it popped. And that's what happens with companies that a lot of companies that are very high quality, they tend to get into a bubble. Mania forms around the stock, and then it pops, and then everyone is a seller. Everyone gets hurt. This is why you should stay away from high PE ratio stocks. You're just gonna get hurt. Okay, but me buying at PE of 11, obviously, I'm never gonna get hurt. I can just close my eyes, and this is not gonna go bankrupt anytime soon. This has a lot of cash to buy back shares, to make some new type of acquisitions, to pour into R&D if it pleases, and to come up with new products that they can release on the market, set up new trends. They can do a lot of stuff. When the margins are high, when you have competent people, when you have smart people working for you, yeah, it's a lot of good things will happen. So the price going down, let's just say conclusion here. Just so I don't forget. So we're gonna make a lot of arguments. And then check out the finalist. Yeah, let's just finish with the valuation, and then we're going to be talking about it. Forward PE, it used to be at 54, 55 forward PE. Now it's at 13. Dirt cheap, okay? Dirt. Already I'm going to be writing dirt cheap valuation. Dirt cheap, okay? For the type of company that it is, I mean, you're just picking up cents on the dollar from the streets. Okay, I'm just walking on the streets and I'm finding money, and I'm picking up money. Making money, it's so easy. You just have to pick it up. Just bend over, pick it up, and put it in your pocket, okay? EV to EBITDA, 43x when it was in a massive bubble. It popped. Now it's at 6. Wow, this company's dirt cheap valuation. 6x EV to EBITDA. Low teen, price to earnings, return on invested capital, very high numbers and consistent. ROCE, wow, I am shocked to see this. I did not remember this company having such high return on capital. I'm gonna tell you right now that I'm gonna be making Lululemon a higher position. I did not remember these aspects, but yeah, looking now at these numbers, I mean, this is almost like my Adobe stock, which I analyzed yesterday. I know it's in the 40s because I looked at it yesterday, but Adobe is like a pristine company on all of the metrics. It has been trending up. But Lululemon has been consistently having around 30 and 40% numbers yearly. This is amazing. I want to be buying this with both of my hands. Pristine, amazing. Amazing numbers, high and consistent. There are very, very few companies that you can find that have not only double-digit return on capital invested in ROCE, but they are over 20%. The average is, yeah, 1 year it was less at 17, and all other years it's like more than 20. I think the average is like 23 or so. That's amazing. The FCF yield, 6%, more than double the stock market average. I'm not sure. I need to check. What is the for the S&P 500? Last time I checked was sitting around 2.8%. I'm gonna pause the video and find the number. So for some reason, it's very hard to find the FCF yield of the S&P 500, but I did manage to find the earnings yield. So S&P 500 earnings yield, forward estimates, doesn't matter. We are gonna look at September 2025, sitting around 3.5% earnings yield. Okay, the earnings yield of Lululemon is 9.4%. That's almost 3 times cheaper than the S&P 500. While all of the metrics are better. Okay, so conclusion: price is down a lot, valuation is dirt cheap, and let's get into specifics here. Earnings yield almost 3 times the S&P 500, while all of the metrics such as ROIC, ROCE are better. Also, the balance sheet is better than the S&P 500 average. But yeah, anyway, let's just rate these green flags. Price 70% down. I'm gonna make this dark green, and then we're gonna be making this also dark green, very high growth top line. I mean, we have compared to something like Synopsys, and it has higher growth than Synopsys. Smart management, buybacks. Yes, this is green, but not as impactful. When we took a look at the cash flow and how much money they were pouring into buybacks, they are slowing down just this quarter alone. That doesn't mean that they're not going to pour more money. It just means that yeah, they're not overflowing with cash. Accelerating buybacks, slight green, good for us. We know that the management here, smart management, they did not buy back when the price was very high. So at least that's a very good positive. Huge margins, an upward trend over the past years. Huge margins for the type of company that it is. It's not huge when compared to something like a software company, of course, but for something like that is just selling pants and shoes and whatever, I mean, that's great. Very good balance sheet numbers. Not pristine balance sheet, but very good numbers when we compare it to something like other retailers. But yeah, as we have seen, Decker's Outdoor was much better in the balance sheet department. So we're not going to put a dark green in here, just normal green. Almost 10% of market cap in annual net income. That's going to be a very dark green flag. Stock-based compensation, non-existent. Huge green flag. Market cap level, same as 7 years ago. Huge green flag, huge opportunity to buy right now. Dirt cheap valuation, low team. 9.4% earnings yield compared to 3.5%. So this is, in terms of valuation, this is a massive green flag. So yeah, you're buying it very cheap. It's down a lot. And not just that it's down a lot, because a company can be down by a lot, by even 70%, and still be very richly valued. If it was in a massive bubble and it had no type of numbers to back it up. But this company has improved over the past decade by a lot. It has grown by a lot, and also the price is down right now by 70%. So amazing. This is, again, very consistent over the past 10 years and very high. We took a look at Adobe. They were growing their numbers over the last 10 years, but this company already had very high numbers. I'm actually curious. Let me take a look at Decker's Outdoor. Do they have those kind of returns on their invested capital? Yes, they have. Trending up and very high. So I like Deckers. I like the Deckers very much. Yeah, we bought it and it went up. I normally do not double down after it goes up. I just let it. We bought it around 100 something. Yeah, and we're up. So a new trend is forming, as you can see. The bottom was July 15, 2025. Created a higher low, and then again a higher low. So this is just going to continue to go up from here, probably. But yeah, the opportunity for us right now, when allocating capital, is going to be Lululemon for sure. FCF yield, like I said, 6%. So again, conclusion: price is down a lot, valuation is dirt cheap, earnings yield almost 3 times as the S&P 500. Everything is conclusion. I mean, the conclusion is this. We wrote all of the, I'm just gonna repeat myself here with the conclusion, but the conclusion is that we want to buy this right now, and we can allocate a bit more capital than I have in my portfolio here. It's sitting at around 2% invested, 1.6%. I'm gonna be increasing my exposure here. I'm gonna be thinking what to trim. Probably it's gonna be PepsiCo again, and a bit of Alibaba. I'm gonna be thinking about what else I can trim. But yeah, anyway, maybe I'll just sell entirely some positions here, such as, I don't know, Diageo, Brown Forman. I'm not sure, but these are small positions anyway. But yeah, that was it for Lululemon. A bit longer video and a bit more interesting, not just looking at the numbers, but also placing some green flags over the numbers that we see. And I'm gonna be doing the next video. I'm gonna be doing something that I'm trying to find red flags for to short. A massive short sell position of mine that you cannot see in this portfolio because I do not short with this portfolio. This is solely for attracting investors, and I want people to invest in me, to copy my portfolio here on eToro. I just want, yeah, no risk, no leverage, no nothing, no borrowing of shares. But in other on other investment platforms, I do have a short on Carvana, so I'm gonna be making a video about that next, and you're gonna see it. So we're gonna do same type of thing where we're just gonna mark red flags instead of green flags this time around. So anyway, good luck in the stock market, guys.